All righty. Joining us now to talk all things market, economy, and the Fed, Phil Orlando, Chief Equity Strategist with Federated Hermes, and Ron Insana, Chief Market Strategist with Dynasty Financial Partners, also a CNBC contributor. I have had the advantage of sitting here for the last 3 minutes, watching Ron Insana's body language and his facial expressions and his head shaking. I don't know where you want to start. Do you want to start with what Rick Santelli said? Do you want to start with what Bob Pisani said? Or do you want to start with what Jim Cramer said? It seemed like you disagreed with all of them.
Yeah, yeah, and look, not usually, right? I mean, that's not my MO to disagree with my colleagues here at CNBC on a regular basis. Look,
well, you're free to.
First of all, like, I don't think the 30-year bond auction means diddly squat. I didn't even know we were auctioning 30-year bonds still, right? I mean, they're not really the bellwether for the market. They're, you know, a smaller, much smaller piece of the auctions than they used to be. And now, again, as Rick himself said, yields are lower on the 30-year than they were before the auction. That happened a lot. When I was growing up in this business, you'd have a bad auction. Next day, somebody come in and buy it at a discount, and the yield will drop back down. So I don't really care all that much about that stuff. I do care about growth. Growth is slowing down. Fed's going to cut next year. I don't care what anybody says.
Could I restate? Because you know that Ron has this perfect ability to always get me going, wait. But could I restate maybe what you've said to say you're more concerned about the slowing economy than about the deficit for now?
For now,
But
yeah.
would you acknowledge that if we weren't slowing, that maybe you'd be more concerned about, you know, the unsustainable fiscal situation?
Well, if we were growing quickly and the deficit were getting larger, I mean, that would be problematic. Now,
that was the past year.
Yeah, but having said that, you know, the Chinese have sold bonds, and the Europeans, my friend John Hilsenrath, our friend John Hilsenrath, used to be at the Wall Street Journal, just pointed out that Europeans have bought more than the Chinese have sold. So the net foreign holdings of U.S. Treasuries are actually higher than they were a year ago. So I'm a little less worried about some of these things.
They're structurally down from like 45 to 30%. But anyway.
Yeah, but net foreign holdings are up to 7.7 trillion, which is above a year ago level, no matter how you want to cut it.
Yeah.
So look, everybody's talking about, you know, if Jim was saying is the economy going to get too hot. Fourth quarter GDP forecast in the Atlanta Fed now survey 2.1%, down from 4.9.
We are Atlanta Fed is usually the outlier on the high side.
Yeah, and so you subtract a full percentage point of growth from that, just as the way it's calculated. So the things I worry about: the wall of commercial real estate debt that's coming due next year, multifamily residential debt that's coming due next year that needs to be refinanced, the slowdown in the economy that's coming, and you know that implies to me that the Fed's going to get easier, not tighter. And I think all the kind of jawboning we're hearing from the Fed is at the moment nonsense.
All right, nonsense, says Mr. Insana. Mr. Orlando, where do you come down in this debate on yields and equity prices and how the two are interrelated?
So let me go back to what Bob Pisani was just talking about a moment ago. He was looking at the day-to-day relationship between Treasury yields and price-earnings ratios, or the performance of stocks over the last week. Let's pull that back to the last several months. From late July, benchmark 10-year Treasury yields were about 3.5%. They ran up to 5%. In that period, the S&P 500 dropped about 11%. We were looking for a pullback of about 8 to 12% down to the 4,200 level. S&P came all the way down to 4,100. Now, what's happening, and I agree with Ron, underlying economic fundamentals here are just simply more important. You look at the labor market, the last set of jobs reports we had, the adjusted non-farm payroll number was soft. The household survey was terrible.
Yep.
Both ISMs have been down. The Michigan data this morning was sloppy. What all of that is telling us is the economy is slowing. Inflation is still kind of sticky and persistent, but we think it's going to be sort of grinding lower. So for all those reasons, Treasury yields ought to be working lower. We'd like to think the Fed is done hiking. I sort of agree with Ron that the next cut from the Fed is the next move from the Fed is going to be a cut. We don't think that cut's coming till the back half of next year, but we think the Fed is done hiking, and that in part the idea that the Federal Reserve is done hiking and is on pause here. Stocks historically rip on pauses, and that's consistent with the 7% rally we've seen in stocks over the last 3 weeks or so.